Hi, I'm Ashish Shanker, Head of Investments at Motilal Oswal Wealth Management. In continuation with our Know Your Fund Manager series, today we're going to be taking a peek into a relatively new asset class, the world of long-short strategies. And to give us insights on this space, I have with me Mr. Vaibhav Sanghavi, who is co-CEO and fund manager at Avendus Alternate Investment Strategies. Welcome, Vaibhav, to the show.
Thank you Ashish for having us.
So, Vaibhav, you guys do something very interesting where you actually take long as well as short positions. Could you tell us a little bit about how these strategies work? And you've also managed a fund earlier at Ambit. What led you to starting a fund at Ambit?
So I think Ashish, the history actually goes back 13 years back when we actually started trading proprietary money for DSP Merrill Lynch. And from there we have been executing this strategy of long short investments. What we have seen across cycles, across years, is that basically it's a great tool to deliver risk adjusted return performance. This is what we concentrate on and deliver on a consistent basis year on year.
What I've understood is that your team has been together now for almost a decade, and you started out at Merrill managing the proprietary capital, and then eventually at Ambit managing the proprietary capital, which led to the launch of the first long short fund at Ambit. I also saw the track record, which is fantastic. I believe you guys have gone on trot for the last 5 years without generating a negative return for any quarter. So how does this work? Could you explain to our investors what you do?
Sure, interesting question Ashish. And now, so for basically what we do on a long short portfolio, on a fundamental basis, the companies which we like, from a combination of approach of a top down and a bottoms up, are the companies which will own for a longer period of time on the long side of our portfolio. Whereas those companies which we do not like, and the reasons can be numerous, starting from broken business model, to negative catalyst, potential negative catalyst over medium term, those are the kind of companies we will go short on. What essentially this does basically is, while you are long and short on different companies at the same point in time, you try to take out the market risk aspect of investing into equities. As everybody would understand and know, that equity markets come with basically two types of risk. One is your market risk and one is your stock risk. Having a long short combined portfolio will essentially mitigate the market risk aspects of investing, and thus if you see on a returns perspective month on month, the volatility in generating those kind of returns is far less than any of the other strategies.
So am I right to conclude that if the markets do go down, your fund will fall lesser than market?
Most likely.
That's interesting, because what my observation has been that most investors don't stay the journey in equities, and that's one of the reasons they don't make money. I mean, typically when markets fall, a lot of clients tend to get jittery and withdraw their money. I also understand that you have two strategies that are currently running. Could you tell us a little bit about both these strategies?
Sure. So currently under our fold there are two strategies. One is Avendus Absolute Return Fund. The whole objective of that fund is basically to generate absolute returns irrespective of market conditions. And there I am aiming at a risk class of debt plus as risk. Whereas the other strategy is basically Avendus Enhanced Return Fund, where what I am trying and aiming to do is basically a relative return strategy versus an equity, in the sense that I am trying to look for equity money wherein my objective in a 3-year time frame is likely to achieve, or our endeavor is to achieve 1.5 times of Nifty. So for example, if Nifty goes up by 50% in 3 years, my intention is to deliver 75% on the portfolio. Whereas at the same time, in a block of 6 months, if the Nifty falls by say X amount, my intention there is to restrict that downside by 1/3. Again, just to give you a number, is basically if the index is likely to go by 10% down in a span of 6 months, my objective would be to restrict it to 30%, which is 3%. So essentially in a nutshell, what I'm trying to deliver is basically returns which are equity plus, risks which are equity minus. So that's the risk adjusted product which we always talk about.
So what kind of investors would the absolute return fund be suitable for?
So in a case of absolute return fund, as I told earlier, we are basically aiming for 15 to 20% gross return, pre-tax, pre-fees, consistently year on year, which translates to about 8.5 to 11% roundabout post-tax, post-fees. Right. Volatility, which is likely to be 1/3 of your index, which is pretty much close to our debt levels.
Fixed income.
Correct. So that is the class of investors which we are aiming for in the absolute return fund, whereas in an enhanced return fund, it is a relative return fund which is benchmarked to equity, Nifty.
So currently you're raising money for the enhanced return fund. So how much have you raised so far and how much are you looking to raise?
Till now, as of last month end, we are around about 1150 crores on AUM, and we think that it's a very highly scalable strategy. We potentially think as of yet that it's a $3 billion strategy over a longer period of time. We would be raising money on a consistent basis on this strategy. However, in an absolute return fund, we have paused for further subscription currently.
So given that you have the ability, unlike other equity fund managers, to even sell some stocks in your portfolio and create a short position, what is your view on the markets in the near term?
Sure. In terms of the view, on a broader view, what we think is basically we are in this whole third cycle of a bull phase. And what do I mean by this third phase of a bull phase is basically in this phase, generally what you see is basically earnings recover. At the same time, you will see interest rates also start to move up. It is extremely difficult to predict how long this phase would last. But at this point in time, we think that earnings are under smart recovery. And what we expect for FY19 and FY20 would be around about 15% growth versus the street which is currently close to about 20%. At the same time, 15% is not at all a bad number, which is a very good number if the end of it they deliver those kind of numbers. So we think that markets are likely to move in sync with the earnings. We don't expect at the same time to market to re-rate further on the higher side in terms of the multiples. So pretty much earning following is what we expect for the market for the next 2 to 3 years.
Right. So how is the fund positioned?
So in terms of the fund positioning, there are two aspects, and let me give some more description what are the two interesting components of this fund. One, 70% of my fund is going to go into long-term investments, 15 to 20 high-quality stocks concentrated on operating cash flow. Whereas the rest 30% of my portfolio would have multi-purpose objectives. One, in a bear phase of a market, we will utilize that 30% to try and hedge our 70% of the investments, which I am holding on to the long side. If in a neutral market or it's a range-bound market, we will try and generate as much alpha on a regular basis as what we are doing in our absolute return as well. And three, in a case where we think the markets are going up, we will use that 30% to actually leverage on the higher side to earn an enhanced return on your 30% of your portfolio, which essentially would bring us to this objective of 1.5 times Nifty over a 3-year time period and 30% downside of the Nifty in a block of 6 months.
Right. A lot of investors are concerned because we are going into a period which is event heavy. I mean, we have several state elections followed by the general elections next year. At the same time, the noise levels from global markets are also going up with interest rates inching up and this constant worry of trade wars. How do you tackle such situations, especially events?
Sure. So, since we are a risk-adjusted return fund, smaller events, probably like a state election, doesn't augur too much, or doesn't. We don't take much of a cognizance in the enhanced return portfolio. While we take that cognizance into an absolute return portfolio, but not in an enhanced because it is a medium to long-term portfolio. Right. Whereas in cases like general election, we will definitely take measures to try and protect the portfolio in those kind of events by using that 30% very, very actively. One, to either hedge on a future basis on that 70% or buy protection in terms of options as well. So the essential point is basically, yes, we would be extremely cognizant of any events like that. As you alluded also to the interest rates movement, which we are again worried about, and which we have seen over the last period of 40 years of history, that whenever US interest rates start to inch closer to 3.5% is where market turbulence starts. We are close to about 3% now. So we are having a close eye on those kind of data which is emanating from the global markets. Thus that 30% is going to be extremely useful to tide over this whole volatility in terms of number of variables which are coming or being thrown out to us.
Long short investing requires a very different kind of thinking is what I understand. I mean, it's almost like right brain, left brain, because you have to be bullish and bearish at the same time, albeit it could be on two different stocks or different sectors. Walk us a little bit through your professional career and what kind of conditioning, mental conditioning it requires to become a long short manager.
No, I think a lot of it actually started coming up right from our Merrill days, where we were part of this whole international strategic risk group, which was supposed to be a big hedge fund, but 2008 happened and it didn't plan out accordingly. But what it helped us achieve is basically try to look from a global perspective these kind of strategies which were pretty much prevalent and common in US, UK and other developed markets. At that point in time, we were among the first ones to get it implemented in India, and we found that in our experience of about 12 years or 3 years, it works beautifully across market cycles. Again, adding on to your point as well, it needs a completely different mindset. While a long only manager will buy good quality stocks and keep it on the portfolio, we don't stop there. We also try to find out those companies which are not going to do good, or those sectors which are not going to do good, which actually helps us to bring out the short positioning into our portfolio as well. So that is how it is actually.
So what are the kind of risks clients are exposed to in these kind of strategies, and how do you mitigate some of those risks?
So in terms of the risks, one of the very important risks is basically to, there can be, events which you don't understand. There can be markets which you don't understand, and we are willingly accepted, saying that if you don't understand, we'll pretty much go into cash. As a philosophy, again, if you either don't understand the market or if there is a binary event, cash is king for us. We try to protect the money first and then try to make our objective in terms of our returns. The risk is basically not making as much money as would the other strategies make. But if you ask me in a down market whether there would be a risk, we would be much better off, that is for sure.
Finally, a lot of asset management companies are filing for these kind of strategies. Any thoughts on how you think this space will evolve over the next few years? Anything that the investors should be mindful of?
If you see, these type of strategies are very, very widely prevalent in the global markets. And if you see, on a global perspective, the asset allocation, about 12 to 15% of the asset allocation is into alternatives. And in alternatives, largest part of that alternative bracket is into long short funds. So globally, these strategies are very, very prevalent. However, in India, we are the leaders at this point in time, and we are looking at people, launching, strategies under the long short umbrella. What we will be mindful of, or would the investors should take a note of, is exactly understand the positioning of the product and the risk. A long short fund can be a very low risk, at the same time can be of extremely high risk, even higher than equity as well. So what the investors should be mindful of is basically what is the objective of the product and how is it in terms of the process and the risks around that product for them to deliver the returns.
Thank you very much, Vaibhav, and I wish you all the best and all the success for the fundraise of the Avendus Enhanced Return Strategy.
Thank you, Ashish. Thank you very much for having us again.
So, investors, that was a very, very insightful discussion on a new evolving asset class, which is the long short, the world of long short strategies. So if you have any feedback or queries, please write in to us on our email ID, on our Twitter handle, or you could go and watch the videos on our YouTube channel as well. Thank you very much.